Since their invention, cryptocurrencies have offered one of the highest rates of return for both traders and long-term investors. However, this asset class is extremely volatile, which means it's easier to lose money on crypto tokens as well. That's why you may be interested in learning technical analysis for crypto trading. Getting started as a beginner is easier than you think. You can learn how in under 5 minutes by watching the rest of this video. What is technical analysis and how is it used for crypto trading? First, let's define what technical analysis is. It's a style of investing that involves looking at an asset's price chart when deciding whether to purchase it. The idea is that the price action of an asset like Bitcoin tells a story about where its price could go in the future. Some traders rely on technical analysis alone when deciding whether to pull the trigger on a new crypto investment. But many use it in combination with other factors, such as overarching market narratives or the price action that similar assets have gone through in the past. The bottom line is that you can use technical analysis however you prefer. It can either form the basis of your crypto trading strategy, or you can use it solely as a means of determining good entry and exit points for trades. How to get started with technical analysis in crypto. Okay, so that's the basis of what technical analysis in crypto means. Now let's look at steps for implementing it in your investment strategy. Here are 5 steps you can follow to start using technical analysis in crypto today. Familiarize yourself with candlestick charts. First, it will be helpful to familiarize yourself with candlestick charts, as these are individual units that make up broader crypto charts. The top and bottom of the candlesticks show you the high and low price of the asset for the period that the candlestick is measuring. You can also look at the candlestick's color to see if the asset increased in price or decreased in price over a time period. Candlesticks are widely used because they provide a quick visual explanation of an asset's price action no matter what time frame you look at. You need to know how to read these before you can start using more advanced technical analysis strategies. Choose a time frame. Next up, choose the time frame that you want to use for your investment decisions. You may have different ones at different points in time and for different assets. Common time frames include hourly, daily, weekly, and monthly. As a general rule of thumb, when you're purchasing an asset for a long-term investment, your time frame should be daily, weekly, or monthly. In fact, it won't hurt to look at all 3 charts to see how the asset looks across several time spans. However, if you want to complete a short-term trade, such as a daily flip, then you could look at an hourly range to get a good sense of your optimal entries and exits. The key takeaway is that your time frame should correspond to how long you plan on holding the asset you purchase. Learn support and resistance levels. Now you're ready to start looking at support and resistance levels. These are the foundation of technical analysis. A support level is a price point at which the asset in question doesn't go any lower, at least for the time being. A resistance level is a price point at which the asset doesn't go any higher, at least for the time being. For example, Ethereum's resistance, as of the time of creating this video, is around $1,900. We can say that because its price is struggling to break and hold the $1,900 mark. But its support appears to be around $1,800, at least on a short time frame. That means each time it dips below $1,800, it pops back up over it relatively quickly. Support and resistance levels are constantly changing, especially as your investment time frame changes. Being able to identify them is a great way to plan entries and exits, with supports being optimal for entries and resistances being optimal for exits. Expand your trading toolkit. Now you're ready to start expanding your trading toolkit. We've just told you the basics. Now it's time to start researching other indicators and chart reading techniques that experts use to make more accurate predictions about where a crypto asset's price will go next. As you do that research, these are the terms you should look up first: EMAs, Fibonacci retracements, Relative Strength Index, RSI, Bollinger Bands. Don't forget your non-technical indicators. And that about wraps this beginner's lesson up. The only thing to note is that it's not usually smart to rely on technical analysis alone when deciding whether to invest in a project, especially as a beginner. Instead, be sure to consider overall market narratives and macroeconomic factors like high interest rates and weak stock performance while planning your crypto investments as well. Was that helpful? Comment your answer below to let us know, and we'll come out with a more advanced guide to crypto technical analysis soon if you think it'd be useful. Thanks again for tuning into Metaverse Memo. Don't forget to like and subscribe before you go. Until next time.